those claims.
All right, so back to the banking sector, Danielle. Do you think that we are still at risk of more banks collapsing?
Well, I think if the FDIC is busily brokering mergers while we're sleeping, Michelle, that there certainly is that possibility. There's no reason to believe with commercial real estate prices falling as fast as they are and interest rates being as high as they are, that you're going to somehow magically have some immaculate refinancing wave where companies are able to go from the loan that they used to have against the property at 3% all the way up to 9% and somehow survive. It just doesn't work like that. And we know that the regional and the smaller banks are up to their eyeballs in these commercial real estate loans that will have to be refinanced at some point. And that will cause more, hopefully, more mergers that we're seeing as opposed to bank failures that incite contagion. But what we saw was a bank failure in the last 24 hours. So this is not over.
All right, so you're seeing consolidation of the banking sector, which tends to, in a way, mask the impact of the collapse, I suppose, at least to the less sophisticated viewer.
Well, it's certainly not a headline grabber. It's not, America's not running out and saying, do I pull all of my deposits from my banks because there was a West Coast bank merger?
Yeah.
So it certainly is not the same kind of headline grabbing, the theater is on fire type of situation. And I guess hats off to the FDIC for being able to broker that deal quietly.
Right. And you anticipate more consolidation then in the banking sector, more of these mergers happening, perhaps, as you say, quietly, discreetly, and not causing mass panic.
Well, I'm just going off of what Chair Powell said at the podium today, and that's that the senior loan officer survey that's coming up Monday is going to show further tightening of credit standards, further tightening of lending standards. At last check, Michelle, banks are in the business of lending. And if they're tightening lending standards, that means that there are fewer loans being made, and that means that there's less business to go around and that we'll see more distress in the banking system.
Well, speaking of credit, you had discussed the liquidity drain of the Treasury filling up its coffers, the Treasury General account, and that could be a potential liquidity event. How is that playing out? Where does that stand at the moment?
Well, we've seen the first $300 billion go by, and it's been okay. We've seen some movement out of one of the Federal Reserve's facility into Treasury bills. Of course, now September's a live meeting. We could see another rate hike coming there. So we don't know that money market funds are necessarily going to continue to buy up these billions and billions of dollars of treasuries. And banks may be getting to the point where they own enough treasuries themselves. We will see how this goes with this next $300 billion. Bank of America's Michael Hartnett has warned that we're seeing $100 billion of liquidity coming out of the global financial system on a monthly basis. And that's going to continue. That was, of course, mitigated when Treasury Secretary Janet Yellen was emptying out the Treasury General account. That is no longer the case. It's moving in the opposite direction. So we will feel the brunt of global quantitative tightening more than we were when we were in the midst of a debt ceiling standoff.
And as we discussed, the markets have been surprisingly resilient. The S&P 500 up, about 19% year to date. A lot of that has been on the hope of rate cuts. Powell said that he does not see any rate cuts this year, potentially next year, but that will be a judgment that they would have to make next year. What's your read on that?
I think markets continue to trade based on hope. I would agree with that assessment very much.
And what is the hope of a rate cut?
I think that hopes for a rate cut would be something that we would be talking about, I think, a year from now.
Okay, as we wrap up, because I know we're short on time, Danielle, last time we had you on, you said be bold in your gold investing. You said that now would be a good time to be bold in your allocation to precious metals. Mm-hmm. Where do you stand on that? Is that still your thinking there?
It's certainly still my actions. As we see Germany fall deeper into recession, and we see that China is not able to rescue the global economy as it has in the past, and we do see other central banks continuing on this tightening path, I would say that that's certainly still an appropriate stance.
Is that more than the traditional 5%, 5 to 10% allocation? Should one be bolder than that? And I understand that individuals' circumstances vary, but how are you positioning yourself there?
I do have more than I would normally have in gold, but by the same token, I have more than I would normally have in cash because it's paying me 6%. So we're in kind of extraordinary times right now. And I think that what people don't appreciate is that when there are alternatives to taking risk, that people will slowly but surely become a little bit more risk averse in how they position their portfolios, and appropriately so.
And how should you be positioning your portfolio? How are you positioning your portfolio these days then?
Well, as I said, I'm making 6% on my cash right now, very happily. So my municipal bonds continue to pay me very well, as does my gold. We have private investments as well. But am I in the stock market? If that's your question, right now I'm not in the stock market.
You're not in the stock market at all?
Me personally, no.